Most investors would look at a Zaxby's in Florida and immediately think safe passive income because it's a strong franchise brand, a tenant who has successfully operated at this exact property for more than 20 years, and now they're voluntarily signing a brand new 20-year lease commitment on the same location. But here's the question I think matters far more than the cap rate. Why would an experienced restaurant operator lock himself into another 20 years at this exact site? Because restaurant operators know their stores intimately. They know which locations struggle, which ones barely survive, and which ones quietly produce reliable cash flow year after year. So when an operator with decades of experience commits long-term to a single property, that's a signal worth paying close attention to. Welcome back to the Commercial Real Estate Deal Room. I'm Mercedes Shaffer, commercial real estate broker, business broker, and the agent who goes beyond the brochure to show you what you're actually buying. This is part 2 of our breakdown of a Zaxby sale leaseback in Ocala, Florida. In part 1, we covered the lease structure, the Zaxby's brand trajectory, and the operator behind the guarantee. But today I want to focus on the part of the deal that ultimately determines whether this investment works long term, the real estate itself. Because a strong brand and experienced operator are important, but if the location does not support the business, eventually the numbers start breaking down. So today we're diving into the Ocala market, the specific retail corridor, the rent-to-sales map, and what the investor returns actually look like once you strip away the marketing language and analyze the deal objectively. Let's dive into it. Before we look at this specific location, I want to talk about Florida as an investment destination, because the state itself is a meaningful part of the return profile on this deal. Florida has no state income tax. I know that sounds like a checkbox item, but let me explain why it actually matters for triple net investors specifically. If you're a high income investor based in California, New York, or New Jersey, states that tax income at rates ranging from 8 to 13%, every dollar of rental income you collect from a property in those states is subject to that tax. When you own a Florida triple net asset, that rental income is not taxed at the state level. On $182,500 in year 1 rent, the difference in after-tax yield between a Florida property and an equivalent California property can be significant. The cap rate on paper looks the same. The money in your pocket is not. This is one of the primary reasons Florida consistently attracts capital from investors in high tax states, and why triple net properties in Florida tend to trade at tighter cap rates than comparable assets in the Midwest. Investors are pricing in the tax efficiency, and for a deal like this one, that tax advantage compounds meaningfully over a 20-year lease term. There's also the broader Florida story: sustained population growth, a diversified business climate, and a destination status that keeps demand for food service concepts strong year-round. Florida has been one of the top performing states for QSR unit economics for years, and the demographic trajectory points to that continuing. Now let's talk about Ocala, because when I looked at the market data on this city, I was surprised by how strong the fundamentals are. Ocala is currently ranked by the U.S. Census Bureau as the fastest growing metro area in the entire United States. The region grew by 4% between 2023 and 2024 alone, reaching nearly 429,000 residents, and it is adding approximately 315 new residents every single week. This is sustained structural population growth driven by affordable housing, a diversified job market, and Ocala's unique positioning as the horse capital of the world, anchored by the World Equestrian Center, which draws significant tourism and event-driven traffic year-round. The median household income within 5 miles of this property is approximately $86,600, a stable, working, and professional population base that supports daily needs, retail, and fast casual dining consistently. The daytime population within 3 miles exceeds 76,000 people, meaning this corridor draws not just the residents, but workers, commuters, and visitors throughout the day. The site itself sits on Silver Springs Boulevard, Ocala's primary east-west artery, carrying 28,500 vehicles per day. Now look at the co-tenancy map from this location: Walmart Supercenter, Lowe's, McDonald's, Wendy's, Walgreens, Wells Fargo, KFC, Outback Steakhouse, Dollar General, AutoZone, O'Reilly Auto Parts, Burger King, and more. These are not coincidences. These are blue chip operators who conduct rigorous site selection analysis before committing to a corridor. And they also chose this one. That co-tenancy tells you this is a proven high traffic retail trade area with an established and loyal customer base. And this specific Zaxby's has been operating profitably on this exact street for over 20 years. The proof of concept is not theoretical. It is documented history. Now let's do the analysis most triple net investors never run, the one I consider non-negotiable for committing to any franchise real estate deal. I need to understand whether the business on this property can actually support the rent it is being asked to pay, not just in year one, but across the full 20-year lease term. This is what I call the rent to sales ratio, and it's one of the most revealing metrics in franchise real estate underwriting. Here's the benchmark. A healthy franchise operation should have rent representing between 6 and 10% of gross annual sales. At 6%, the business has strong financial flexibility, room to absorb capital labor increases, and funds required for capital improvements and to handle a slow quarter. At 10%, you're at the outer edge of what most systems can sustainably carry. Much beyond that, and you start watching a slow compression that eventually becomes a real problem, which is exactly what we have seen drive many of the franchisee bankruptcies happening in the market right now. Now let's apply this to a Zaxby's Ocala. The system-wide average unit volume ended 2024 at 2.71 million, with top quartile units hitting 3.3 million. If this location is performing at or near the system average, a conservative assumption given its 20-year track record on Ocala's primary corridor, the year one rent of $182,555 represents approximately 6.7% of gross sales, comfortably inside the healthy range and closer to the favorable end. Restaurant level EBITDA margins across the Zaxby system reportedly run between 15 and 20%, translating to roughly $400,000, $530,000 in annual operating income for an average unit, against a $182,555 in annual rent. Even a below average performing location has meaningful coverage. And remember, an experienced operator does not commit to 20 more years at a location where the math is tight. That commitment is itself a form of due diligence the operator has already done on your behalf. When I work with buyers on deals like this, if the lease includes a sales reporting requirement, we sign an NDA and review 3 years of actual financial statements. That information stays completely confidential, but it becomes the most important input in the underwriting process. This is what separates a well-informed investment decision from one built on assumptions. So let's step back and talk about what this deal actually is, because I think that matters more than obsessing over every spreadsheet calculation. This is not the kind of deal you buy because you're trying to maximize year one cash flow. It's the kind of deal investors buy when they're prioritizing durability, simplicity, and long-term positioning. You have a proven operator who has successfully run this exact location for more than 2 decades. A long duration, absolute triple net lease with zero landlord responsibility. A growing Florida market with no state income tax, and a restaurant brand that appears to be in the middle of an operational upswing rather than a decline. Those are meaningful strengths. And honestly, I think this is where investor psychology becomes really important. Some investors look at a deal like this and immediately focus on the fact that the cap rate is not especially high. Others look at the exact same deal and see something very different. A clean, passive income stream attached to a proven business in one of the fastest growing metros in the country. Neither perspective is inherently wrong. It simply depends on what role the investment is meant to play inside your portfolio. Because real estate investing is not always about chasing the highest possible yield. Sometimes it's about building a portfolio of durable assets that can quietly compound wealth over long periods of time through rent growth, loan pay down, tax advantages, and appreciation in the underlying real estate, especially for investors coming out of active business or management-heavy multifamily properties. There can be real value in owning an asset where the day-to-day operational burden essentially disappears. So here's my overall verdict. If your primary goal is aggressive day one cash flow, this probably is not the right fit for you. But if you're looking for a long-term passive income, strong operator history, and a location that has already proven itself over more than 20 years of operation, I think this deserves serious attention, particularly for a 1031 exchange buyer looking to transition into something cleaner, simpler, and more passive long-term. What do you think? Does a long-term sale leaseback with a proven operator in a high-growth Florida market justify a tighter cap rate? Let me know in the comments. And if you're evaluating triple net investments or navigating a 1031 exchange, my contact information is in the description below. I'm Mercedes Shaffer. This is the Commercial Real Estate Deal Room. I'll see you in the next deal.